Hello girls, we will go to see today what is known as the management of public debt. How the public debt is managed. What agencies are responsible for public debt management? What do you mean by public debt management? So, the strategy for managing government's debt is called the management of public debt in order to raise the required amount of funding and achieve its risk and cost objectives. So these are associated with public debt, right? The government has to get a minimum amount of funding and government has to um, minimize its risk. Risk in the sense debt, amounting debt may lead to um, what's that called? Debt trap. Yes, in the case of individuals. So, government has to minimize the risk of borrowing and also the cost objectives. What is the cost of borrowing? Which also is associated with the risk only because how much is the money has to spend for um, cost. That's the cost of public debt. So actually, that cost is mainly in terms of taxing the people in order to repay the public debt, um, and also how the future generation is going to get affected. So, in order to um, meet these objectives, government manages its debt. So, debt management means the strategy of the government for managing public debt. For what? In order to raise the required amount of funding to achieve its objective, risk and cost objectives. Then, to meet any other debt management goals of the government, such as developing and maintaining an efficient market for government securities. So, this is also another issue, another aspect of public debt management. What is that? To meet the other debt management goals of the government, such as developing and maintaining an efficient market for government securities. Now, there should be an efficient market for government securities because through the government sale of government securities that the government borrow from the public. So there should be an efficient market for government securities. It's like the what's that called? Gilt edge securities, treasury bills, etc. Okay, these are all government securities. So there should be the market for this is efficiently maintained. So this is also called the management of public debt. Since you have the portion management of public debt in India, so you will be learning only that. Okay. So public debt management of the Union Government of India. How Union Government of India manages public debt. That's what we are going to learn. So the overall objective of the central government's debt management as laid out by the central government's status paper in November 2010. So the overall objective of the central government's debt management policy as laid out by the central government status paper in November 2010 is what? Is to meet central government's financing needs. Okay, so what is the strategy, objective of debt management policy of the government which is given in the central government status paper? It is number 2010 is to meet central government's financing needs at the lowest possible long-term borrowing cost. So, financial needs must be met at the lowest possible cost for a long-term borrowing and also to keep the total debt within sustainable levels. So, the total debt must be kept at sustainable levels. Okay, that is a debt liability ratio. That's how much is the public debt in the total um, GDP of a country. This is what we look into. So that should be kept at the sustainable levels. Additionally, also what is additionally means, and also it aims at supporting government of a supporting development of a well functioning and vibrant domestic bond market. Okay, so this is the objective of the debt management policy of the government outlined in 2010. What is that? Financing, the government's financing needs must be met at lowest possible long-term borrowing cost and keep the total debt within the sustainable levels. And also, it aims at supporting development of a well-functioning and vibrant domestic bond market. So there should be a well-functioning and vibrant domestic bond market must be developed in order to meet the central government's financial needs. So this is the objective of the government's debt management policy. So the public debt management in India, how public debt is managed in India. So government published its first debt management strategy, that is DMS document, earlier published across various documents of the government and the RBI. Okay, so it's the first debt management strategy of the government on December 31st, 2015. What is it? The scope of DMS is restricted to active elements of domestic debt management, that is marketable debt of the central government. Okay, so the scope is where it is, this is restricted to only internal borrowing. That's what is meant. Restricted to active elements of the domestic debt management and marketable debt of the central government. So marketable debt means the debt can be sold in the market by the people who take this government securities. Okay, so that is the scope of the debt. DMS is restricted to domestic debt management and marketable debt of the central government. Over time, the scope would be progressively expanded to cover the entire stock of outstanding liabilities, including external debt, as well as general government debt, including state development loans. So, the first is that, and then over time, this scope will be progressively expanded to cover the entire stock of outstanding liabilities, that is both the internal debt and also external debt. External debt, as you know, it is a there should be a different strategy for managing external debt, right? External debt cannot be managed by just selling the government securities. For that, there should be increase in export, right? We have already seen that. So liabilities including external debt as well as general government debt, including state development loans. State also is also taking loans. So everything will be also covered in its scope over time. That's what they have planned in 2015. The objective of the debt management strategy is that is in 2015. Okay, debt management strategy is to secure government's funding at all times at low cost over the medium long term while avoiding any excessive risk. So what is the debt management strategy? Objective of the debt management strategy DMS is to secure the government's funding at all times at low cost over the medium long term while avoiding any excessive risk. So government has to avoid all excessive risk associated with the borrowing, and government has to secure fund at all times at low cost, both in the medium term and also in the long term. You know, shorter term loans otherwise also the risk is lesser and the cost is lesser. So medium and long term loans must be acquired by the government at a low cost, and that is the objective of debt management strategy of the government. It is published in 2015, DMS. Then, DMS has been articulated for the medium term for a period of 3 years. So, medium term must be period of 3 years and would be reviewed annually and rolled over for the next 3 years. Okay, so medium term um, will be for 3 years, and after reviewing it annually, it will be rolled over for the next 3 years. Okay, next is um, India is not now. When you look at the internet, you will see the IMF strategy and World Bank strategy, debt management strategy. But India is not formally using the IMF, World Bank medium-term debt strategy and debt sustainability analysis. India is not formally using that. Many countries across the globe follow the target medium-term public debt strategy, specifying the debt targets to be met and the strategies for achieving the same. In India, such a framework or document is not in existence. However, in the medium term, fiscal policy statement laid before the parliament a 2-year target for outstanding liabilities is incorporated. So in India, it is medium term. What's happening? The term fiscal policy statement laid before the parliament that a 2-year target for outstanding liabilities is incorporated. The fiscal policy strategy statement. In the fiscal policy strategy statement laid before the parliament, government outlines prudent debt management strategies so as to ensure that public debt remains within the sustainable limits and does not crowd out private borrowing for investment. So it is very important. So in the fiscal policy strategy managed statement of the government that is laid before the parliament, what is the government objective? Government outlines the prudent debt management strategy. What is that? So as to ensure that public debt remains within the sustainable limits and does not crowd out private borrowing for investment. So, public debt must remain in the sustainable limits. So, that is tested by debt to GDP ratio, and it does not crowd out private borrowing for investment. So, what happens, when the government collects from the people through selling its securities, in the hands of the public, that means people will have less money for investment, right? So they will adopt this policy in such a way that it will not crowd out private borrowing for investment. It's very important. So government when borrowing, government will see that the private investment is not crowd out, which means private investment is not reduced. Okay. So what is the another reason is that when the interest rate is very high, people will deposit their extra funds with the government. That will crowd out the private investment, the private borrowing, because interest rate is very high. That also is there. Now, as per the Fiscal Policy Strategy Management Statement of 2012-13, the public debt management policy of the government is driven by the principle of gradual reduction of public debt to GDP ratio. You see now, what is the policy here? Public debt management policy is that there should be a gradual reduction of public debt to GDP ratio. So, public debt to GDP ratio. That means you take the total amount of the public debt and then divide it with the total GDP. What you get and multiply with 100, you will get the ratio or the percentage of public debt to GDP. And that percentage of public debt to GDP must be gradually reduced. So that is the public debt management policy of the government to not only 2012, 2013, but also all over the years. That's the objective of the government to reduce the public debt GDP ratio. This is this is with the objective of further reducing the debt servicing risk and to create fiscal space for developmental expenditure. So debt servicing risk has to be reduced. That means debt servicing risk means what? Paying interest on the debt, borrowing amount, that has to be reduced and create a fiscal space for developmental expenditure. And what for while taking that debt, that what it has to be used for developmental purposes. So both these are there. One is debt servicing risk has to be reduced and then create a fiscal space for developmental expenditure. Now, on the financing side, government policy focuses on the following principles. So, what are the principles followed by the government on the financing side? Financing side on how to finance the borrowing. So, greater reliance on domestic borrowing over external debt. So, when you want to reduce the what's the debt servicing risk, so what are the policies government focuses? What are the principles government follows on the financing side? That is the minimizing the risk debt service. Okay, so that can be possible. So therefore that a greater reliance on domestic borrowing over external debt. What does it mean? Borrow from within the country, not from outside the country. Because as you know, when you borrow from abroad, you have to also consider the exchange rate. You have learned international economics, right? Have you know? Learned. So exchange rate means the rate at which one country is exchanged for another country's currency is exchanged for another country's currency, right? So suppose, as I told you also before, another video I have explained, suppose the government is taking debt, borrowing $1, okay, $1, which is at present, while borrowing time it was equal to maybe 60 rupees. Okay, now when the exchange rate depreciates, what happens? Indian rupee gets depreciate. What happens? The government's burden of giving that loan increases. Because then now next year, suppose the exchange rate is equal to 100 rupees for so every $1 you have taken only 60 rupees, but now you have to repay on 100 rupees in terms of Indian rupee. Okay, this is a burden. That is why the greater reliance on domestic borrowing over external debt is one policy in order to reduce the financial risk. Okay, cost of service, debt servicing, etc. The second one is preference for market borrowing over instruments carrying administered interest rate. So their preference is given for market borrowings. So market borrowings means you can sell that securities in the market again, resold. So, okay, instead of carrying out administered interest rate. So an administered interest rate is that's the government has to administer interest rate. Instead of that, market borrowing is preferred. And then consolidation of the debt portfolio. Consolidation of the debt portfolio. So then development of a deep and wide market for government securities to improve liquidity in the secondary development of a deep and wide market. So not only market borrowing, but there should be also a wide market for government securities. That means it should be spread over so that many people can get the government securities to improve the liquidity in the secondary market. Okay. Now, what are the institutions responsible for management of public debt? The Constitution of India gives a executive branch of government the powers to borrow upon the security of the consolidated fund of India. So it's the Constitution of India that gives the executive branch of the government, that is for the government, the powers to borrow. They can borrow from where? Upon the security of the Consolidated Fund of India. Now, when a government wants to borrow, government also has to have some security, na, for borrowing. What's the security? Security of the Consolidated Fund of India. Government has a fund, a consolidated fund is there. From that fund, the government can issue security. So that the security is kept as a consolidated fund of India. Now, Reserve Bank as an agent of governments, both union and states, used to implement the borrowing program. So the borrowing program is implemented by the Reserve Bank as an agent of the government. Now, Reserve Bank draws the necessary statutory powers for debt management from Section 21 of the Reserve Bank of India Act 1934. So, Reserve Bank draws the necessary statutory powers for debt management from this section of the Reserve Bank of India Act 1934. While the management of union government's public debt is an obligation for the Reserve Bank, the Reserve Bank undertakes the management of public debts the various state governments by agreement. Okay, so the management of the union government's public debt is an obligation of the Reserve Bank. But the Reserve Bank undertakes the management of public debts of the various state governments by agreements. Okay, it's not a binding, but as an agreement. Now, what are the institutions responsible for debt management in India? The jurisdiction of various institutions responsible for public debt management is given below. First one is the Reserve Bank of India. Now, what are they doing? Domestic marketable debt, that is dated securities, treasury bills and cash management bills. These are the area which are specifically undertaken by the Reserve Bank of India. Secondly, Ministry of Finance, MOF, Office of Aid and Accounts Division. So that sees to the external debt. And Ministry of Finance, this is Office of Aid and Account Divisions. Okay, other divisions are there. Now, Ministry of Finance, Budget Division and Reserve Bank of India, other liabilities such as small savings, deposits, reserve funds, etc. So these are the jurisdiction of various institutions in management of the public debt. Reserve Bank of India, you will see all the domestic marketable debt such as dated securities, treasury bills and cash management bills. Ministry of Finance will operate, especially its Office of Aid and Accounts Division will manage the external debt, and the Ministry of Finance, the Budget Division and the Reserve Bank of India, the other will manage the other liabilities such as small savings, deposits, reserve funds, etc. For monetary and fiscal coordination, there is a cash and debt management committee which meets regularly. The the members comprise of officials from RBI and also Ministry of Finance. That's also monetary and fiscal coordination. There is a cash and debt management committee. Okay, that also will meet regularly and the officials from RBI and the Ministry of Finance are the members of such a committee. Okay, such committee. Okay. So this is all about the fiscal public debt management in India. I shall also give you a useful video to summarize everything. Okay, to understand where do we stand in the debt position. What are the different marketables? So what are the different but instruments that are used for borrowing our internal debt? What are the instruments of external debts, and how much is the internal debt, how much is the external debt, etc. For that, I will share a video with you all. So with this, we are going to be finishing the public debt portions. Okay.